the biggest question I get currently is, of course, about gold and silver, because we've been told now for years by people like us that are warning that debt is out of control and that, short-term stimulus money printing doesn't solve anything and just makes it worse. But everybody says gold's going to go to $5,000 an ounce. And we've been told that gold is the one true money, the one true currency, and the one thing that'll go up when everything goes down. And first of all, it just hasn't been that way. In 2008, when we finally had the financial meltdown in the second half of 2008, especially like between September and November, gold collapsed. Gold was down 33% from June to October, November. Silver was down 50%. So they weren't the protection. I think the thing to understand about gold in this deflationary era we're talking about, in this winter season, is that gold goes up in anticipation of a financial crisis, but when the financial crisis actually hits, we do see private debt deleverage. We see commodity prices go down further, and that causes deflationary trends, and then gold goes down because gold is always expecting, financial crisis or slowing economy, money printing is going to lead to inflation or hyperinflation. So our point has been, no, we're in a deflationary era, and you have to understand that governments are going to unprecedented levels of money creation and stimulus and fiscal stimulus and bailouts simply to fight deflation, to fight debt deleveraging. So the thing to understand here, when debt deleverages, especially private debt in a downturn, after a debt bubble and a financial bubble, financial assets deflate, debt deleverages, and money is destroyed. So there's less money and wealth chasing the same goods, and that's the definition of deflation. Gold is an inflation hedge ultimately, and a crisis hedge, but more an inflation hedge. That's why it did so well in the summer season, the last economic crisis that lasted 14 years, from 1968 to 1982. Gold was the ultimate hedge. Now, ultimately, here's the question, why did gold suddenly collapse in mid-2013, this year? Gold had seen a major spike into September 2011 on endless QE and money printing programs. And then it went sideways for a year and a half in a channel between $1,525 and $1,800. Now, normally, I'm telling you, from studying chart patterns for 30 years, that would have broken up to one more new high out of that channel. Moving sideways after a big move up is bullish, but instead, it broke down out of that channel into June of this year to $1,179. Once it broke $1,525, it was toast, and we were warning of that. It shouldn't break that. Why did that happen? Two things. The Indians and Chinese are the biggest buyers of gold, together 52%. But the Indians, up until this year, were slightly by margin the largest buyers of gold. The Indian rupee started going down in value around May of this year forward, and Indians kind of pulled back on their gold buying and have a bit ever since. But the biggest reason is that the markets finally got what we're saying. The U.S. went QE3 even stronger, and then QE3 plus, and it looked like forever for a while. The Japanese in early 2013 gave the most aggressive stimulus program of any major government yet, 2.5 times the impact of QE3 in the U.S. when adjusted for the size of the economy. After this escalated stimulus, inflation rates around the world, and especially in the United States, for example, went from 2%, already extremely low, despite massive money printing, down to 1%, and now it's still less than 2%. So again, the markets finally we're not going to get inflation, we're not going to get hyperinflation, and people started selling gold. Well, hedge funds and investment funds have been buying gold just like oil back in 2007 and 2008 on high leverage, and then they're forced to dump for margin calls. So you keep seeing gold have these big sell-offs. So gold has been mortally wounded from my point of view. And if you're into gold, you might want to keep a little bit, especially silver coins for disaster. But I'm telling you, they're inflation hedges. We've got deflation ahead of us. All of our indicators say stocks are going to be down in 2014. The economy is going to be back down. I think gold is headed in the next few years to $700 to $740. which is the next major support area. And ultimately, in the next decade, with commodity prices down and in a bad economy, as low as $250, where it bottomed and where the last bull market started between 1998 and 2000. So my advice, fall out of love with gold. Keep a little if you want, but be selling gold on rallies. And again, gold goes up in anticipation of crisis. It could go up one more time, even into early next year before the economy falls. I think the economy is going to be in trouble by the second quarter. So if gold goes up to somewhere between $1,400 and $1,520, up to that $1,525 support level, I would be a seller. I know this is hard to stomach because a lot of us love gold, but gold has lost its luster. Thanks for listening.